All right, so the 2026 federal budget has officially landed. And if you're a property investor or thinking about becoming one, this is probably the biggest shake-up to property tax settings we have seen in decades. Now, before we jump in, a quick disclaimer. This is general information only. It is not financial, legal, or tax advice. Everyone's situation is different, so before making any decisions, please speak with your accountant, financial advisor, mortgage broker, or solicitor for personalized advice. Now, with that out of the way, let's unpack what actually changed because there's a lot of noise out there right now. So, the two big headlines from this budget for property investors are number one, changes to negative gearing, and number two, changes to capital gains tax, or CGT in short. Starting with negative gearing, under the new rules, investors buying established residential properties will no longer be able to use rental losses to offset their personal income like wages or salary. In simple terms, if your investment property is making a loss, you can't use that loss to reduce your PAYG tax anymore, unless it's a qualifying new build, of course. Now, importantly, existing properties held before budget night are grandfathered. So if you already own investment properties before the announcement, the current rules remain in place for you. And if you buy a new build that qualifies, negative gearing is still available under the new regime. Now on to capital gains tax. The current 50% CGT discount is being replaced from 1st of July 2027. So instead of getting a flat 50% discount after holding a property for more than 12 months, the government is moving back toward an inflation indexed model. So effectively, investors will only be taxed on the real gain after inflation adjustments. But there's also going to be a minimum 30% tax rate applied to gains. And again, existing holdings and gains accrued before the change are largely protected through transitional arrangements and grandfathering provisions. Investments into new bills will come with the option to choose between the 50% CGT or the indexation pathways. So that's the what changed part. Now let's talk about what this could actually mean in the real world. First, existing investors who already hold property. If you bought before budget night, realistically, your portfolio probably becomes more valuable from a policy perspective overnight. Why? Because you're sitting in the grandfathered environment. You still retain the old negative gearing rules. You still retain the existing CGT treatment on gains accrued till 1st of July 2027 under the old system. That creates a split market. Pre-budget assets and post-budget assets are now fundamentally different investment products from a tax perspective. And whenever governments create scarcity around a favorable tax treatment, existing holders often become beneficiaries of that scarcity. Now, does that automatically mean prices boom everywhere? No, because prices are still driven by borrowing capacity, affordability, employment growth, supply and demand. But I do think we'll likely see stronger relative demand for established investment stock over time, especially in tightly held blue chip suburbs and established areas where land supply is constrained. Now, second, what about investors looking to buy after the changes? This is where strategy becomes really important because the government is clearly trying to redirect investor demand away from established dwellings and toward new construction. So, under the new system, new builds become significantly more attractive from a tax standpoint. That means house and land packages, off the plan apartments, townhouse developments, knockdown rebuilds that add supply. They're all likely to become the focus of investor activity. But here's the thing people need to understand. Just because something has tax incentives doesn't automatically make it a good investment. And this is where buyers need to be very, very careful. A poor quality asset with tax benefits is still a poor quality asset. You still need to assess location, demand drivers, supply pipeline, vacancy rates, employment growth, infrastructure, owner occupier appeal, long term scarcity. Because in property, the asset quality still matters, potentially more than the tax outcome. Now, third, what about investors who already own property and want to draw equity out to buy again in the new environment? This is a really interesting one. Historically, a lot of investors use equity growth from established properties to keep compounding into more established properties while using negative gearing benefits along the way. That strategy becomes less powerful now because if the next purchase is an established property post budget night, the tax treatment changes significantly. So, what I think we may start seeing is existing investors using equity from older, grandfather assets to fund either new builds, small developments, duplex projects, or value add construction strategies. Essentially, the policy settings are trying to steer investor capital toward adding housing supply instead of recycling existing stock. Whether that actually solves affordability is another question entirely. Fourth, let's talk about borrowing capacity. Because honestly, I think this is one of the biggest parts of the conversation that many people are missing. Negative gearing historically increased after tax cash flow for many investors. And lenders absolutely consider tax benefits when assessing serviceability. So, if investors can no longer offset property losses against their PAYG income on established dwellings, their effective borrowing power may reduce. That means buyers may simply not be able to pay the same prices they previously could. And when borrowing capacity falls, price growth usually slows. Now, will this affect all markets equally? Probably not. Unaffordable investor heavy markets could feel this more sharply. Why? Because many of those markets are driven by investors relying on negative gearing and tax efficiency to boost their cash flow. If the numbers no longer stack up as strongly, demand may soften. On the other hand, prestige suburbs and tightly held owner occupier markets may be less impacted because people still want to live there and they may only have established stock available, with potential scarcity of land ensuring not many new builds flood the market and offset demand for these established stock. But even there, reduced investor competition can still change market dynamics. I also think we may see a widening divide between new build corridors versus established inner ring suburbs because the tax settings now heavily favor new supply. Fifth, will incentives for new builds actually help first home buyers? This is where the debate gets really interesting. In theory, the government is trying to encourage more housing supply and reduce investor competition for established homes. And on paper, that sounds logical. But in practice, many new estates are located in greenfield corridors, often far away from established employment hubs, lifestyle precincts, transport networks, and social infrastructure. A lot of first home buyers don't necessarily want to live 60 or 90 minutes away from where they work or where their families are or where their social circles are. So while supply may increase on the outskirts, that doesn't automatically solve affordability in the locations where demand is strongest. And there's another issue. If investor demand leaves established markets, but construction costs remain high and developers still struggle with feasibility, there's no guarantee we suddenly get an enormous wave of affordable housing delivered. That's why I think this budget may reshape demand patterns more than it solves affordability outright. And finally, where to from here? Personally, I think we are entering a completely different era of Australian property investing. The old playbook of buy established property, negatively gear it, wait for growth, pull equity, repeat, that model just became far less straightforward for future purchases. Going forward, I think successful investors will need to focus more heavily on asset selection, cash flow management, construction feasibility, manufacturing equity, adding value, and understanding local supply demand fundamentals. I also think buyers need to avoid making emotional decisions right now. There's going to be fear, there's going to be political noise, there's going to be headlines saying the market will crash. and others saying property will boom forever. The truth is usually somewhere in the middle. Markets adapt, investors adapt, policy evolves. And as always in property, there will still be opportunities, but the strategy probably needs to evolve with the environment. The key now is understanding the rules properly, understanding how lenders will assess deals under the new settings, and making decisions based on long term fundamentals rather than short term headlines. And again, please seek professional, personalized financial, tax, and legal advice before making any investment decisions because everybody's situation is different.